Hello, investors and traders, and welcome to this episode of Technical Tuesday, where today we're going to be focusing on the hammer candle and the shooting star, how to identify them and also how to trade them while managing risk in the process. First, the hammer, where the body of a candle is the rectangle shape that we have here. Some of the candles are long and tall, others are short and stocky. In this instance right here, we have a very small body candle with a long shadow underneath the candle, which is going to be 1.5 to 2 times the length of the body. And as you can see here, the shadow is more than 2 times the length of that body. So that qualifies the candle as an official hammer. Now, the other thing is, I talk about the 80-20 rule quite a bit. 80% of the time, when you see the hammer candle show up at the end of a downward leg, 80% of the time, it will result in prices moving to the upside. Very important that you remember that. It's very easy to find on a chart because of that shadow. It's also very easy to identify when looking at a stock that has long up legs and down legs. I'll get to that in a moment when we show the actual charts and how to find these. And the color of the body doesn't necessarily have to be green. It could also be red, as long as it's at the end of that downward leg showing that long shadow. So that's the hammer candle. The next one is going to be the shooting star, which basically is the hammer candle turned on its head. Here's what it looks like. Again, another small bodied candle with a shadow above the body that's 1.5 to 2 times the length. Again, the color of the candle does not matter, but what does matter is that this candle shows up at the end of an upward leg. And so again, it's another one that's easy to identify. It sort of pops out at you when you're looking at a chart. And so these are among the top 4 of my favorite candles. The last video we did talked about engulfing candles. These are the long shadow candles. The shooting star and the hammer are more or less grouped together. And they're, like I said, very easy to identify and very easy to trade. Now, let me just go back to the hammer candle. Let me show you the how-tos in trading this. The reason the candle has a long shadow underneath is because on that day, the sellers tried very hard to push it and keep it down to a new low. But the buyers came back with force and pushed it off the lows. So what's happening here intraday is the candle in and of itself is reflecting a pivot point intraday. It's a change in the force between the sellers losing their control and the buyers coming in, taking over control. So a lot of times I will be buying on a candle such as this and using the low from that pattern as the place where I would put a stop loss order, right? So in other words, if you buy on this candle, it doesn't matter, where within the body you're buying that, you're putting your stop down below the lower end of that shadow, because if it is a failed hammer, meaning that the next day it goes lower, then you're going to have a lot of people getting stopped out and moving out because it's not 100% accurate. It's 80% accurate with a 20% chance that it could fail. So that's the reason why you want to put a stop loss order or set up your exit strategy on a failed hammer candle. The opposite would be true for a shooting star, where option traders especially are going to be shorting the market when they see a candle like this. So most of the option traders who get into the options are going to be buying puts. Not too many people short the market these days because you have unlimited upside risk. But with the options, you could manage that risk. And so this is 80% of the time you're going to see, after that shows up at the end of an upward leg, 80% of the time it's going to move lower. So if you're putting an option position on in the form of a long put, you might want to consider getting out of that position should it close above the high of the day or close above the upper end of that shadow. All right, so those are the ways to identify the candles. Those are the way to trade the candles, and those are the ways that you're going to manage risk using those candles. So let's take a look at an actual chart. This is Warner Brothers, and as you can see here, the long shadows pop right out at you, right? You see that candle right there is a shooting star. Now, notice how that candle with the long shadow shows up at the end of this upward leg. You see, so I'm showing you the shooting stars first, and then we'll move along to show you the hammers. Here is another shooting star. See the long shadow at the end of an upward leg. Now, it didn't completely reverse the day after, but you could see the result and how the price of that stock did sell off after the shooting star showed up. Now, here's one that I pay attention to, but it's not going to qualify as a shooting star. See, if I magnify that for you, you could see that the shadow is not 1.5 to 2 times the length of the body. In fact, it's not even as long as the body itself. But I do pay attention to those because when you see the long shadows on top, again, it's telling us that in each one of these instances where you see the long shadow, it tells us that the buyers tried to push it up to a new high but failed. And that is taken as a downside signal or a bearish signal that you have to pay attention to. Another thing that you want to keep in mind is that if you're long a stock, let's say, for instance, you bought Warner Brothers down here at 8.5 and it trades all the way up to 12.5, and you're getting greedy now trying to squeeze out those extra pennies, but now you see a shooting star, you might want to consider taking the profits or at least trailing your stop up to protect those profits. You see, where is a hammer candle? Right there. You see the long shadow underneath the body of that candle right there? Well, it almost immediately pivoted higher. If you had your stop set, you would not have gotten out of the trade if your stop is below the low. In fact, it went back down to test the low and then went through its very strong rally in this up leg that I'm pointing at right here. So you could see that the stock rallied about 25% after that hammer candle showed up. So hammers are bullish, shooting stars are bearish. Here is another hammer. It's kind of hidden within this grouping of candles down here, but you can see the long shadow underneath. What happened shortly thereafter? It rallied from around $8 all the way to 9.5, and then we saw a role reversal resistance right here where the profit taking pushed the price down. Okay, so if we look at another very popular stock, let's take a look at Microsoft here. And again, just scan the chart. Take a look at what you're seeing and look at the candles, look at the shadows. Remember what you learned in previous videos with regard to volume and oscillators and things like that. Well, some of the more obvious ones that pop right off the page is right here is one of the shooting stars. Again, found at the end of an upward leg. What happened? It took a couple of days, but the stock dropped from $4.55 all the way down to $4.15. So it dropped $40 after that shooting star showed up. It dropped $40. So again, if you're long the stock and you see a shooting star start to pop up on your chart, you might want to think about protecting your profits, maybe even exiting some of that position and or at least raising your stop to protect those profits. Okay, here is a hammer candle, right? We just went from shooting star to hammer, flipping back and forth because they're easier to find on the chart. See, here's the end of a downward leg. We start to see some of the sideways move here. Then the hammer candle shows up. And what happens shortly thereafter? It goes from $4.15 all the way up to $4.40. So it rallies $25 up after that hammer candle showed up. Here's another hammer. Now, one thing I want to point out, what I showed you in the example with a perfect textbook hammer, sometimes you'll see a little bit of a shadow on top. That's okay. I still categorize that as a hammer candle as long as it's showing up at the end of a downward leg. The same thing for a shooting star. If you see a long shadow on top, maybe there might be a little bit of a shadow underneath. That's okay. As long as it's at the end of an upward leg, I'm looking at that as a bearish signal. So just to recap, hammers are bullish candles that move the price up usually 80% of the time after that shows up. Shooting stars are bearish candles where 80% of the time you'll see prices drop after that candle shows up. That's not 100% guarantee, but I'll tell you, I'll take 80% anytime. And that's why you have to protect your position. Because if you buy the stock on this hammer right here, and you put your stop down below the bottom of the candle, if it fails 20% of the time, then you're not going to get hurt, or you're not going to suffer any kind of a catastrophic hit. Sometimes you got to look more closely. Like I said before, sometimes they're buried within a grouping of candles. Like right there, you see that hammer. And if you practice and each and every week you go over charts and just scan them, look for the hammers, look at what happened after the hammer showed up, look for the shooting stars, then look what followed the shooting stars. And then you could go back and review some of the bullish engulfing, some of the bearish engulfing candles. And then you pay very close attention to those, and you'll have a better time of it in the market when you're putting the odds in your favor. So that is our episode for today. Thank you for joining us. Make sure you stay tuned for the next Technical Tuesday, and I'll catch you on the next video. So long.